to go for this make good test, sit for make good test. Your make good test will be conducted on Sunday. This Sunday, 4 p.m. to 6 p.m. So this Sunday is, today is 6th September. So this Sunday will be 12th September. Okay, yes, correct. Thank you, Zihong. 12th September. All right, 4 p.m. to 6 p.m. So according to, if I'm not mistaken, according to the Google Classroom, your paper will be released at 3:45 p.m. So I let you have 15 minutes reading time. Please use this 15 minutes reading time to read the question, okay? In the event that, I know that a lot of you are telling Dr. Mavis that the paper, the questions are very long, okay? But as I have already mentioned to you, the questions, it has to be very long, because in the future, when you come out to work, the situation will not be a very short situation. It will be a very long situation also. You need to understand the situation fully, and in order for you to answer the questions correctly. And I also noticed, actually Dr. Mavis provided me the feedback that the time for you to complete is not enough. Basically, all of you are asking for additional half an hour. So I have gotten the approval. So that's why your test will be from 4 p.m. to 6 p.m. But I will release the paper 15 minutes earlier. So please utilize this 15 minutes earlier, okay, to read up the question, to find all the keywords for the answers, all right? And then at 4 p.m., you can start to draft your answers already, all right? For those who are not required to sit for make good test, congratulations to all of you. Well done. Okay, please keep it up. All right, and then I will continue to guide all of you up until your final exam, and continue to complete the revision hub questions. All right, if not, then it's very difficult for me to help you also if you did not do revision. All right, the topic to focus, Jinghui, as I have mentioned, I cannot tell you which topics to focus. The main reason is because for your consolidation question, you will be tested on all the topics as well, the topics that you have studied. So don't think that consolidation, you only need to focus on unrealized profit, all this consolidation adjustment, all right? You will be tested on other adjustments as well. So if I only tell you a few topics to focus, at the end of the day, consolidation, you cannot score. It is also the same thing. Ended up also will fail. All right, I do not want this thing to happen. So I already specified to all of you, I'm not hiding anything. The first question itself is consolidation question, 40 marks. The second question itself is ratio analysis, which is 30 marks. Okay, for ratio analysis, as I am covering with all of you today, nothing to hide also. Definitely, they will ask you about ratio interpretation. They will also ask you to calculate ratio. I am not very worried about students unable to calculate ratio. Most of the time, students can calculate very well. The only thing that makes me worried is on the theory part. So later on, I will also guide you how to answer theory parts. All right. For certain things, you will be able to answer one. For certain things, maybe you will do like what you are doing in the past. This is lower, that is higher. You will use that comparison. But of course, if you just compare lower or higher, you won't be able to secure a single mark. Because at your level, we are not looking at lower or higher. All right. Topics to focus for make good, it is the same thing. I already specify in the make good test announcement, topic 1 to topic 7. So which topics to focus, I don't know. But the most important thing I have already highlighted to you, please complete your tutorial questions and your revision hub questions, your revision hub subjective questions and answers. If you have completed, no reason why you will fail. If you did not complete, then yes, you will fail. Okay, so the questions are in there. All right, so you just need to focus on that. All right, so I don't want to waste your time now. Let's move on to your ratio analysis. Okay. Let me just make it bigger. Okay, so for the first question, Serene Berhad is a PLC. Below are the extracts of the financial statements for the financial year ended 30th June. Statements of profit or loss for the financial year ending 30th June. We have 2020 and 2019. So as you can see, most of the ratio analysis If possible, we will have 2 years of comparison. But if I'm not mistaken, last year, I made it as no comparison between last year and this year. I made it as a comparisons between budget. All right. So for this question one is a comparison between last year and this year. So they will provide you SOPL and SOFP for sure. Okay, and the main thing here is on the notes part. On 1st July 2019, Serene Berhad had sold the net assets, including goodwill, of a separately operated division of its business for 8 million, on which it made a profit of 1 million. This transaction requires shareholders' approval, and in order to secure such transaction, management has agreed to declare a dividend of 40 cents for each share in issue out of proceeds of sale. The trading results of the sold division, which are included in the statement of profit or loss for the financial year ended 30th June 2019, are as follows. So which means in year 2019, your SPL, you have already included the sold division figure. Okay. And the following selected ratios have already been computed. So they have already calculated these few ratios for all of you. Okay. So this actually includes the sold division as well. All right, so you need to calculate the equivalent ratios for Serene Berhad for the year ended 30th June 2019, after excluding the contribution made by the division that has been sold, and for the year ended 30th June 2020, excluding the profit on the sale of the division. Okay, so for year 2019, you have to exclude the contribution made by the division that has been sold, which means you have to minus off this part. All right, when you calculate your ratio, please remember to minus off this part. For year 2020, you have to minus off this part. Okay, because these are all one-off transactions. So since it is a one-off transaction, we have to take it out so that it is comparable. That's the whole idea why we have to take it out. Like for year 2019, we do not have any profits from the sale of division. So if I add in for 2020, it won't be accurate anymore. Your ratios are considered as non-comparable. So that's the whole reason why we have to take out. Okay, same goes to your 2019. Yes, they have already computed this for all of you. But it is good that you also take it out. Okay, so that you can compare with 2020, because in year 2020, we do not have that division anymore. All right, so the A part is to calculate equivalent ratios, and the B part is to comment on the comparative financial performance and position of Serene. All right, so as you can see here, actually I have already just provided the answers to all of you. Okay, so this 2019, your gross profit margin, operating profit margin, this should be something that is very not something new to you, something that you are very familiar with, because you have already computed this margin long time ago. All right, so you have GP margin and operating profit margin. So return on capital employed, it will be based on net profit before interest and tax divided by capital employed. So why are we taking in NPBIT most of the time, before interest and tax? The whole rationale is because we want to know what is the actual profit earned after we have taken out the interest and the tax portion. Which means if I am only purely using my own money, what is the actual profit earned? Or I will have to, so that I can actually make comparison and I can actually analyze on the financial statements. Which means we assume that without interest, without the assistance of borrowings, what is the profit that I am earning? That's why we take in net profit before interest and tax. And we have this net assets turnover because I want to know, based on my capital that I have, what is my sales? Okay, how good is my sales? So from there, I will be able to gauge if I am utilizing the capital provided by the company effectively or not. So that's why these four ratios are very popular ratios. And we do have this ROCE check. This ROCE check is basically for you to identify if you have calculated your ROCE correctly. So how do you identify? Basically, it will be your operating profit margin times net assets turnover. Okay, you will be able to get back to the same answer as your ROCE. If not, simply means that your ROCE calculation is wrong already. All right, so that's about it for your calculation. Okay, so in the event that you are confused, you've forgotten which formula it is, all right, feel free to go and check your ratio analysis week 12 ratio analysis question on this part, right? Okay, first And second page itself, I have already stated all the formulas for all of you. So in the event that you have forgotten about the formula, never mind, you can check from here. Because when it comes to your face-to-face exam, basically formulas are provided to you as well. Okay, so it's okay for you to refer to the lecture notes to get back to the formula. Okay, but we won't ask you to calculate all the ratios now. All right, at most we will ask you to calculate about maybe 4 ratios for 2 years or 7 ratios. That's it. Okay, if we won't ask you to calculate more than 7 ratios. Most of the time, what we want you to do is you must be able to analyze the financial statements correctly. So the interpretation part is most important, as it will help you to gain more marks. All right, but either in the event that you don't want to do analysis question, then no choice lor. Make sure you can score your ratio calculation. You must get it correct lah, because it will be half out of 30 marks. Okay, so about 14, 15 marks, it will be ratio calculation. All right, and another 14 or 16 or 15 marks, it will be on the analysis. All right, so that's it for your ratio, yeah? All right, so now if you want to calculate your gross profit margin, so as you can see from my formula here, okay, 22 million minus 8 million divided by 45 million minus 18 million. So this is basically from where? This is basically from your question as well. This is gross profit margin, right? So your gross profit for this 2019-2020 is stipulated as per below, and you are required to take out the profit division, the sold division's revenue, gross profit. You are required to take this out. So that's why you can see 22 million minus 8 million. I'm taking out the gross profit earned from this sold division divided by 45 million. So 45 million will be your revenue, okay, minus 18 million, which is your 2019 sold division's revenue. Okay, so I get 51.85%. As for 2020, it is quite straightforward because nothing for you to deduct. Okay, you just take in the figure. As for operating profit margin, so as you can see here, I am also taking in 13 million. So it's a profit before interest and tax, and minus of your profit before interest and tax for sold division. Okay, and then divided by your sales. Okay, as for your 2020, it is also the same thing. Okay, but the only thing that you have to minus off is on the 1 million of the profit that you have actually earned from the sale of division. Okay, so this 1 million you must take out in year 2020, because as you can see, year 2019 we do not have the transaction. So year 2020 we also take out in order to promote comparability, so that at least we know what is happening, whether they sell this division is actually a good thing to do or not. All right, and then we have our ROCE here. Your ROCE, how do you calculate? Basically, net profit before interest and tax divided by capital employed. Now, just in case you don't know what is capital employed from my explanation here, you will be able to identify as well. Capital employed basically refers to your capital contribution by shareholders and amount borrowed in order to fund the operation. That is capital employed. Hence, the calculation, the ratio, the formula for capital employed will be total assets less current liabilities. But of course, you also have to be very careful, just in case your current liabilities, you have the loan element as well. Because here we are talking about the amount borrowed to fund the operation, which involves the loan element. Okay, so here we have in your statement of financial position, you have your equity. So you can just take in your equity figure, okay, and you add on your non-current liabilities of 8 million. For your current liabilities, you do not have this 10% term loan, okay, 10% loan note, so you can just ignore. So you just take in 14 million plus 8 million will do. Okay, so it's equivalent to your total assets minus your current liabilities. It's okay, total assets minus current liabilities equals to equity plus non-current liabilities. So basically it is the same. So that's why you see here you have 14 million plus 8 million. 14 million of equity plus 8 million. Okay, for year 2020, it is also the same. You have 13 million plus 4 million. Okay, so that was your calculation for your ROCE. So ROCE comparison, it compares between the non-profit before interest and tax and compared to your capital employed. So from here, we want to know, based on the capital that I have contributed, how much profit I am currently earning. Okay, that's the whole idea why you calculate ROCE. And then you have net assets turnover. So this net assets turnover will be your sales divided by capital employed. So your sales figure, okay, will be your revenue figure lah. Revenue divided by capital employed. So your capital employed equivalent to your equity plus non-current liabilities. All right. And then you have your ROCE check. So as I have mentioned here, your ROCE check is equivalent to operating profit margin times net assets turnover. That would be your ROCE check. Okay, and this was stated as per question in year 2019, stated in the question here. All right, so now we have 3 items to compare. So our analysis, we will have to make comparative financial performance and position of Serene Berhad now. Okay, we need to analyze now. So let's have a look at our analysis part. So if I look at your gross profit margin, okay, let's have a look at the gross profit margin. So you will notice that year 2019, without the division, it seems to be better compared to year 2019 with the division. All right, so it simply indicates that maybe the cost of goods sold for this sold division is a little bit too high. So without this sold division, it seems that the gross profit performance is much more better. But in year 2020, after we have excluded the profit on the sales of the division, it actually drops. So from here, we roughly know that maybe it is because of the bad business, or maybe because of a change in marketing strategy. This is something that we cannot identify. Okay, maybe the sold division, they are able to bring in more business, but for the current divisions that are unsold, they are not able to bring in more business, so they have to do more marketing strategies, whereby definitely you will earn lesser profit. In year 2019 seems to be okay. Year 2020, you know that the profit has already deteriorated. Okay, and now we look at your operating profit margin. If I look at operating profit margin, year 2019 without the division, it is not good. Okay, of course with the division, it seems to be better. But 2019 without the division, it seems to be a little bit worse. Okay, slightly decreasing. So from here, we can roughly gauge that maybe because of the sold division's profit that they earn, they are actually using the money to fund other divisions that are not earning money, or not earning enough money to cover the expenses, the operating expenses. In year 2020, we can see that the profit, the operating profit has declined by 20% after we exclude the division. So from here, we know that the business is actually not very good already. So it might indicate a downsizing of the company. So they are not really operating very well. The expenses are too high. So for all this, we need to have more evidence together, because according to the question, they only provide a few informations to you, mainly on the sale of this division. Okay, so they did not provide other informations to you already. So in order for us to strengthen our analysis, we need more information to confirm that our analysis is correct. Okay, the next part is on ROCE, your return on capital employed. So return on capital employed with the division, it seems to be much better. Without the division, it is slightly worse, all right, by about a drop by about 20%. So a drop by 20%, it could be explained because of the reduction in your operating profit margin and also a reduction in your net assets turnover. So this, it could be explained because of these two reasons. So as I have mentioned, all right, everyone, please jot down this part because this part is very important. When you explain about ROCE, you can only explain based on your operating profit margin and net assets turnover net assets turnover ratio. That's the only way to explain on ROCE. You don't have to touch base on other things already. So here we know that it is a drop because there is a drop in your operating profit margin. There is a drop in your net assets turnover. So what does it mean? It simply means that a drop in your operating profit margin, as per explained just now, the operating expenses are too high. Without the sold division, basically it's not enough to cover. The money that they earn is not enough to cover the operating expenses. As for your net assets turnover, you can see that it is rather low. Okay, it is rather low. It could be because they have this huge loan that they have to make payment. Okay, so that's why it is quite low. All right, with this 2019 with the division, basically it is much more better because they have more assets to cover perhaps. But 2019, after we have excluded the division, we excluded all the assets that we have sold, it seems that it is rather low. Okay, on your net assets turnover, it is rather low, which means the company is not utilizing the capital good enough or efficient enough to boost the profit in year 2019. Okay, and this is basically on your ROCE check. For year 2020, you notice that your ROCE is a very huge drop. Okay, of course, it is because of the drop in your operating profit margin. But if compared to year 2020, your net assets turnover basically it's higher. Why it is higher? It is higher because of the non-current liabilities part. There is a huge repayment. That's why it actually increases your assets because your liabilities are lesser. All right, that's the reason why. Okay, so if you look at my explanation part here, profitability in year 2019, after excluding the sold division, it seems that the gross profit margin has improved, signifying that selling the division seems to be a wise choice. But in year 2020, there is a huge drop in gross profit margin, which might be caused by a higher cost of sales or a change in marketing strategy, of which further information is required for investigation purposes. So as you can see here, normally when I prepare analysis, I will not straight away confirm that my analysis is 100% correct, like higher cost of sales or a change in marketing strategy. Most of the time, I will just add in further information is required for investigation purposes. But of course, it is because the question, they didn't specify anything about a change in marketing strategy or higher cost of sales. So this is all based on my assumption only. So that's why I need further information to confirm my analysis is correct. It is reported, and in year 2019, after excluding the sold division, operating profit margin seems to show some decrease. So it could be led by higher expenses incurred by other divisions, which was funded by the sold division. So as you can see here, basically your gross profit margin is better. But when it comes to operating profit margin, it is a drop. So which means the operating expenses are higher on the unsold division part. It is more lower on the sold division part. So that's why we have this conclusion that maybe because of the expenses incurred by other divisions, they are funded by the sold divisions. But in year 2020, we no longer have this sold division to help in the funding. So that's why the operating profit margin shows a huge drop. Okay, so your ROCE, everyone, you have to take note on this part. Okay, they are mainly affected due to two reasons only. So when you explain on ROCE question, remember to just quote these two things. Okay, the first was operating profit margin. The second would be the effectiveness of utilization of the capital employed. It is basically because of these two reasons only. So it is very easy for you to analyze on ROCE. So as you can see in year 2019, with the division, ROCE is higher. Without the division, ROCE is lower. And the main reason is because a reduction in operating profit margin, a reduction in net assets turnover. So here, as you can see, it seems that operating profit margin reflects a lower ratio. So we can conclude that Serene Berhad might have sold the most profitable part of the business. A drop in net assets turnover indicates that Serene Berhad is inefficient in utilizing its resources to run the operation. So basically with this, it is also sufficient for you to earn a mark for your ROCE explanation. Here you can earn at least 2 points already. Okay, so we are only talking about the effectiveness and efficiency in utilizing resources to run the operation, and also on the lower of operating profit margin, which could be because of what reason. Okay, so 2019, that was it. So in year 2020 compared to 2019, there is a huge drop, and this huge drop is mainly because of operating profit margin. So of course you cannot straight away just tell people it is because of the two reasons, a lower of the two reasons. Okay, because in year 2020 our net assets turnover shows an improvement, and this is an improvement. It is not because of anything, but it's because of a decrease in loan, indicating large repayment of the loan. So when your liability reduce, of course, your assets would increase. Okay. So other issues, according to the question, Serene Berhad paid a dividend to their shareholders in order to obtain approval to sell. So according to the question here again, you see, sometimes you might think that the information is too lengthy for you. But all this information, it helps you to analyze your financial statements better. Okay? So that's why according to this question, they have also mentioned that this transaction requires shareholder approval. And they really want it badly, that I want to secure this transaction. Okay, I want to secure this transaction, and the management has agreed to declare a dividend of 40 cents for each share in issue out of proceeds of sale. So which means in order for me to secure this transaction, I declare a dividend to you. So this is something that is very fishy, because how can you just declare a dividend because you want to succeed in this sale? So this is something that is rather fishy. So as you can see here, they have been paying a dividend to the shareholders in order to obtain approval to sell. So when we look at the profitability and ROCE ratio, it seems that it is unwise for Serene Berhad to sell off the division. So it is quite questionable that you have offered shareholders a high dividend to persuade them to vote for the disposal. Another impact was Serene Berhad only received 1 million. So as you can see here, they made a profit of 1 million. Just making a profit of 1 million, and you have disposed of a seemingly good division, a seemingly profitable division, then this seems to be illogic. All right. And Serene Berhad will also have to pay out a sum as a dividend. So this 1 million could have been largely used as a repayment of dividend. So they have no sufficient money to run the operation. So summary part, it seems that it is unwise for Serene Berhad to sell off the most profitable part, and Serene Berhad is only earning a small sum. Okay, so it has coincided with a remarkable deterioration in profitability, and the process of the disposal had not been wisely utilized. So here we are not sure whether is it because Serene Berhad has an indication to downsize the business, which we need further investigation before any conclusion could be made. Okay, so that was it for your explanation part. So when we have these four issues, these four ratio, most of the time we have to explain about the profitability part, and then on the ROCE part, and if there is any other issues that you would like to explain, and then you only explain about the summary. Okay, that was it for your ratio. All right, so it should be quite simple for all of you, especially for ROCE. Always remember that it is because of the two reasons. Okay, it will not run out. All right, there won't be any other reasons. It is because of these two reasons only. Okay, so any questions you want to ask me? Or you can understand this part? Everyone can raise hand if you can understand this part. All right, thank you. Okay, so sorry, I need 30 seconds. All right, the next part, let's move on to the next question. Okay, the next question is on KDK Berhad. KDK Berhad is a listed company. Until 1st July 2019, it had no subsidiaries. On that date, it acquired 80% of Pan Asia equity shares via cash. So this is the summarized financial statements of KDK Berhad as a single entity at 31st December 2018 and as a group at 31st December 2019. So this is the statement of profit or loss. So here we have specifically emphasized that this is a group and this is a single entity. So from here, you already know that it is not really comparable because one is at group level, one is at single entity. And you know that group level, we have amalgamation of financial statements, which means I combine the financial statements of a parent and subsidiary. So from here, you must be able to identify this separately already. Okay, so other information, KDK supplies goods to Pan Asia at a selling price of 1 million each. After the date of acquisition, consistently earning only 10% profit margin from such sale. The values of property, plant, and equipment held by both companies has been rising for several years. KDK Berhad's CEO made the following comments upon reviewing the financial statements. Gross profit margin compared to previous year had dropped by 11%. So this is bad. I thought that our GP margin should have massive improvement after the acquisition of Pan Asia. Referring to my comment in A, I suspect that gross profit margin dropped due to lower profit margin earned on the sale to Pan Asia. We had acquired Pan Asia. Why is our share capital in consolidation only reflects our own share capital? So A, you have to reply the 3 comments, and B, you have to calculate the following ratios. Also the same thing, the 4 ratios, and then comment on the comparative performance. So let's reply the comments by the CEO first. Gross profit compared to previous year had dropped by 11%, and you thought that there should be a massive improvement after the acquisition because CEO also believed that there is an amalgamation that has taken place. Amalgamation means we actually include the subsidiaries sales, subsidiaries profit or loss into our account. So your revenue part here currently shows a combination of parent plus subsidy. Okay, that was according to his interpretation. It is correct. However, you have to first look at the question. The question has already mentioned this is 31st December 2019 financial year end, and acquisition is on 1st July 2019. So it's considered as 6 months acquisition only. Since this is just a 6 months acquisition, we cannot 100% confirm that the loss making or a reduction in GP margin, it is because of acquisition of Pan Asia Sdn Bhd. Because when we amalgamate, we only amalgamate 6 months financial statements of Pan Asia in KDK. 6 months profit or loss of Pan Asia in KDK. From 1st Jan to 30th June, it belongs to Pan Asia. It does not belong to KDK. Okay, so as you can see here, the acquisition of Pan Asia Sdn Bhd took place on 1st July, financial year at 31st December. So this is just half-year acquisition. A drop in GP margin might not be caused by acquisition of Pan Asia Sdn Bhd. And the analysis is incomparable because KDK Berhad was a single entity in year 2019. KDK Berhad becomes a group of companies in the middle of the year 2020. So it could only be comparable with 2018 if single entities report is obtained, which means 2019 and 2018 is comparable. But 2019 and 2020 is not comparable because KDK has become a group of companies. In year 2019, it is still a single entity only. All right, that was how we addressed the issue for question A. And for comment B, he was suspecting that gross profit margin dropped due to lower profit margin earned on sale to Pan Asia. Now here we all know that sale and purchases, intra-group sales and purchases will be eliminated at console level. So basically, any intra-group sales and purchases will be eliminated at console level. So certain ratios might not reflect accuracy at single entity level, such as intra-group transactions. So in year 2020, year 2020, KDK single entity will reflect revenue which includes intra-group transaction as well. But for KDK single entity in year 2019, basically it is not really comparable. All right. Such intra-group sales and purchases will be reflected at single entity level, but it's not at consolidation level. So in year 2018, this is 2018, in year 2018 single entity level, all right, it is considered as incomparable even if we obtain 2019 KDK single entity, because intra-group revenue has already been taken up in 2019. In year 2018, we do not have that. And that, even if we have that, it was considered as third parties transaction. It is not intra-group transaction. So it's not considered as comparable as well. All right, because at consolidation level, it has already been eliminated. All right. And the last point was we had acquired Pan Asia, Sdn Bhd. Why share capital in consolidation only reflects own share capital? Because in accordance with IFRS 3 business combinations, share capital of Pan Asia, Sdn Bhd. Has already been taken up in computing goodwill. So we only reflect the parent's position. Okay, so here you need to calculate the ratios A, B, C, and D. Okay, so I believe everyone must be able to calculate the ratios already. Yeah. Okay, at single level and consolidation level, you also have your ROCE check. So if we look at 2018 and 2019, one is single, one is console. We already know that basically it is incomparable. All right, it is incomparable because of the following reasons. Intra-group sales and purchases, it will be eliminated at consolidation level, so reflecting third-party transactions, but this consolidation has already been amalgamated. So which means I have combined the financial statements of parent and subsidiary. Hence, in year 2018, it only reflects a single position. It is not really comparable. Okay, not really apple to apple. Okay, and another thing is that this is just a half-year acquisition. So since it's just a half-year acquisition, it is very difficult to decide whether this 2018 and in year 2019 is the profit really drops because of the acquisition of Pan Asia, or it is solely because of KDK. If we really want to compare, then you have to obtain the financial statements of Pan Asia, financial statements of KDK, and then we make comparison again. But of course, we also have to take into consideration that there is these intra-group transactions that has already been taken in at single entity level. Okay, it will be eliminated at console level. So it might not really be comparable as well, unless you take out all the third-party transactions, but you take out all the intra-group transactions at single entities level. All right, and then you will be able to reflect the actual third-party transactions. Okay, then it might be comparable. So there are several things that you have to take in. All right, and in year 2019, we have this capital employed figure. So you notice that this capital employed figure, I just take in 64 million. So where do I get 64 million? Basically, all right, basically, this is a ROCE at console, right? Your capital employed, 50 million. Here, 64 million. So I just take in your equity part because we do not have non-current liabilities that is related to loan. Okay, so I just take in the equity part of 64 million here. And this basically includes NCI. But in year 2018, it does not include NCI. Hence, we can say that it is also incomparable. It's not comparable. Even if we look at the assets figure, we have this goodwill in year 2019, but 2018, we do not have goodwill. So in order to promote comparability, by right, we have to also take out the two items. Okay, so that was it for your comparative performance. So here, you should know that basically for year 2018 and 2019, it is incomparable because One is at single level, one is at consolidation level. There are several things that we have to take out in order to be able to compare, because single entity should also reflect only third-party transactions. At console level, even though they are reflecting only third-party transactions, but there is amalgamation that has already been taken place, which means we are combining the financial statements of two companies. It is quite difficult for us to identify whether the loss is contributed by KDK or the loss is contributed by Pan Asia. So we need to obtain their single entities financial statements in order to be able to identify the actual reason better. Okay, that was it for your question number 2. Any other questions that you want to ask me? Can raise your hand if there is no question. All right, thank you. So if there is no question, then I'll see some of you on Sunday, 4 p.m. for your Make Good test. Okay, thank you very much, and I'll see all of you on Wednesday. Thank you very much. Have a nice day, everyone, and bye-bye.